Welcome, everyone, to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Hiran Amin. One of the biggest headlines in early 2023 has been the financial troubles in U.S. banking. See, a handful of regional banks failed, sparking concern and raising questions among some investors about the resiliency of the American banking system. Financial regulators quickly stepped in to help curb the potential risks and assuage fears to the other banks. However, some investors might still question how secure major financial institutions may be, including those here in Canada. Well, we're going to take a closer look at some of the factors that may influence the long-term stability of the Canadian banking system. That way, investors can make up their own minds when evaluating the sector. And we're going to get some perspective from a guest speaker steeped in financial industry experience. Joining us is Rob Wessel, co-founder and managing partner at Hamilton ETFs. Rob, thanks so much for being here with us here today.
No, it's my pleasure. Thank you for the invitation.
All right. Well, excellent. Well, I look forward to our conversation here today, Rob. But before we get started, I do want to get to know you a little bit better. So you have 29 years of experience under your belt in the Canadian financial industry. So can you share some of your experience and how it's helped you keep a pulse of the banking sector?
Yeah, so thanks. So I started my career in financial services in 1995. I've spent some time in corporate finance, investment banking. If my name sounds vaguely familiar to some of your audience, it might be because I was a top-ranked Canadian bank analyst. Each and every year I covered the Canadian banks, and then worked a little bit in trading. And then about 13 years ago, co-founded Hamilton ETFs, which is a financials focused asset manager based in Toronto.
Yeah, and actually on that note, so you launched Hamilton ETF. So why did you decide to launch that ETF provider and focus specifically on the financial sector with the funds that your team offers?
You know, our background, myself and our co-founder and our team, our life and our experience was in the financial services sector. As you know, it's a gigantic sector. It's certainly globally, it's way bigger than the Canadian equity markets, many times larger, in fact. And we just thought the financial sector lent itself to sector specialization. And so we felt that we had value to add. And so here we are 13 years later.
All right, I'm looking forward to unpacking some of the metrics that you used as a financial analyst to assess this banking sector. But before we do, just a quick note to our audience. The purpose of our discussion isn't to comment on current headlines about US or Canadian banks. Instead, we are focusing on some of the fundamental factors that investors can consider in general. We're also discussing Rob's personal approach to evaluating the resiliency of Canadian banks based on his professional experience. But there are many ways investors may choose or might choose to research them as investments. So take our discussion here today as food for thought in your own process. And with that said, let's get right into it. There's been concern among some investors about the health of the US banking sector following those regional bank failures that we mentioned.
Mhm.
In broad strokes, can you explain why those banks ran into trouble?
I mean, obviously the headline and the biggest issue was Silicon Valley Bank. And so its ticker was SIVB. SIVB, which is how people refer to it, which I'll refer to it as well. So SIVB was a very idiosyncratic bank in many ways. And this was a very idiosyncratic event. So Silicon Valley Bank was a bank, as you might guess by its namesake, was one that banked the tech sector. And so Silicon Valley Bank actually, during COVID, saw its deposits grow by 100%. So just by way of reference, a bank that had deposit growth of 4% would be incredibly happy. Not 100, but 4. They end up at the peak of COVID, when rates are very low. They put all of this money into marketable securities. They classify it as being held for the long term. So that's your starting point. And then following that, two things happened. The tech sector, well, interest rates rose significantly, and the tech sector came under some significant stress. And so you started to see clients withdraw their deposits. And then, they started talking on Twitter and things like that. And you effectively had what was a modern day run on the bank, a crisis of confidence, if you will. And it did kind of spread a little bit out to some other companies. First Republic is an example. But the reality is that Silicon Valley Bank, First Republic, Signature, these are the three banks that were the most in the headlines. They're just not large enough to cause systemic issues. Now I think you're going to deal with the more significant issues, which is the regulatory response. For example, today in the Wall Street Journal, they were talking about banks needing to increase their capital by 20%. You're going to see, banks having to pay more to get funding in the global markets, which will reduce net interest margins, which is a primary measure of profitability. The event itself was concerning, but the after effect is probably going to be the one we deal with for a while.
All right. And, this leads to a natural question. Some investors might assume that Canadian and American banking systems are very relatively similar, and that the troubles that have occurred out there can stem and crop up here. So as someone who's worked in the industry for a long time, what are the key differences for investors to understand between our banking systems?
The differences between the two business models, they are quite stark, in fact. So the Canadian banks are what you would define as universal banks, which is to say, back in the late 1980s, the different businesses which were distinct from a regulatory perspective, were allowed to merge with each other. And the banks, Canadian banks, which at that time were just basically commercial lenders, they could buy the trust companies, they could buy the investment banks, they could start their own asset managers. And what happened is they became universal banks, which is to say they're very diversified across all of the business lines and by revenue, by product, and geography. The vast majority of US banks are garden variety banks, lending. They take deposits, they lend them out. That's what they do. Therefore, they tend to be more of a play on geography. So if you're a bank in Texas, people think more about how's the economy in Texas. If you're a bank in Florida, the same. Or maybe you're in the Northeast, something like that. Because you have less diversification, you can be more vulnerable to some of these types of issues if they emerge. As well, you can also be more vulnerable to maybe distress in particular geography or particular loan category, because there's literally thousands of banks in the United States. Another big difference with the Canadian and US banks is in Canada, we have an oligopoly, which is to say we have the market essentially divided depending on the let's say everywhere outside of Quebec, essentially divided up by 6 large institutions. They have a lot of discipline on pricing and how they manage the market. And that in and of itself is quite a stabilizing variable.
And actually, on that note, since you talked about this diversification, I guess a lot of our investors may not be familiar with how Canadian banks actually make their money or revenue. So can you take us through some of those main lines of businesses for a bank over here?
There's the personal and commercial bank, which is, the part of the company where, you go get your mortgage, you get your car loan, your credit card, and so on. They also have these large investment banks, which have all sorts of businesses related to the capital markets. We all know that they have wealth management. This is part of the call that we're on right now. So they have full service brokerage, discount, so on. Every single Canadian bank has meaningful operations in some of those businesses in other geographies. So while it's true that they're all financials, all of these different silos, and it's true that they do and can be correlated, it's also true that they provide a lot of diversification across the whole institution. And a lot of times, I've been following the sector for 28 years. There's a lot of quarters where something is not doing that great. One of those businesses is not doing that great, but another one is doing really well.
Speaking of that, now we've established that the Canadian banking sector, as we know, is diversified, generally speaking. So, what does history then say about the resiliency of the industry?
2 things have worked well for the Canadian banks in terms of bringing stability. One is a very pro-bank regulator. The Canadian government, Ministry of Finance, OSFI, which by the way only came into effect in the late 80s, have been very pro-bank, and that has been a very significant positive for the banking sector. The second thing is just this diversification that came as a result of that regulatory outcome has in and of itself helped create a much more durable system. And then lastly, after the global financial crisis, there was some significant regulatory reform. Almost all of the global banks had to double the amount of capital. In 2018, you had new loan loss accounting coming in. Now you have this extra layer of reserves, which by the way now is $20 billion. So you start with 1998 and you get all the way to today. You have banks that are much more diversified, have many, many times more capital than they had. And now they have a reserving methodology, which also is another layer of significant strength.
Yeah, absolutely. And I think also, would you say that in going that contrast and comparison, that Canadian banks in general would you say that we're more risk averse compared to our American counterparts?
No, I don't know if I would say that. I think that would be flattering to Canada. What I will say is the Canadian banks, as a business, have lower credit risk than a US bank does, not because of risk tolerance, but because in Canada, the residential mortgages are held on bank balance sheets. So you have these huge loan portfolios, which are relatively low risk. In the United States, residential mortgages are typically held at two large institutions called Fannie Mae and Freddie Mac, as well as they're securitized into the market. So you have a higher risk, higher loss category loans on US banks than you do relative to Canadian banks, even if the overall banking sector in each country, has a risk tolerance that's not all that different.
All right. Well, yeah, thanks for that, unpacking that and clarifying that for us. Let's move on. So now that we've kind of understood a little bit about Canadian banks and how they operate, let's drill down on some of the factors that you consider when evaluating their resiliency. And we're going to start by asking about a key one is Bank of Canada's monetary policy. So how might this impact Canadian banks?
Monetary policy influences GDP growth, and nominal GDP growth is the major correlating variable for revenues. And monetary policy also influences inflation, which is the most important variable determining growth in expenses. So you saw in a higher inflationary environment, for example, in this most recent quarter, the Canadian banks had much larger increases in expenses than people had expected. Really, what you're hoping for is contained inflation, so the monetary policy can be stable and predictable. You hope that interest rates can stay within a narrow band. Everybody is comfortable with that band. Inflation is the enemy of financial assets, which is a bank balance sheet. So you want and hope that inflation is low. And so you can tie all of that back to monetary policy. But I think I wouldn't say monetary policy to the banks. I would say monetary policy to the economy to the banks.
So why is it that when you have rapid and unexpected changes in this interest rate policy, that it can have or lead to an outsized impact on Canadian banks in particular?
How much time do we have? I mean, we could talk about this for over an hour all by itself. This is an unbelievably important and somewhat complicated area. But what I would say is an unexpected and very rapid increase in rates, which is obviously what we're seeing right now. That's the effect. The cause was inflation getting outside of the bounds and beyond the expectations of the central banks, having to increase rates significantly and quickly in an effort to try to tame inflation, weighs on GDP growth. As I said, because GDP growth correlates with revenues, and also it influences credit. So generally speaking, if rates are moving quickly up or down, it usually means something bad is happening. If they're moving in a sort of gradual, controlled way, it's easier for banks, to fund their businesses. It's easier for them to figure out how much to price their loans. It's easier for them to manage their trading books on the investment banking side, for example. And the market likes predictability. The market likes, what do we think the banks are going to earn in the next 2 years? And if interest rates are moving very gradually and slowly in a predictable way, then the market feels more confident in earnings estimates, which means the market can pay more for that dollar of earnings because the expected volatility is lower. When you get these periods with very large increases, it creates a lot of uncertainty like you have right now. And not surprisingly, you have a lot of uncertainty right now, and the Canadian banks are trading at very low valuation. So there's definitely an ebb and flow or cause and effect to this, to monetary policy for sure.
Absolutely. And also, just speaking to that, I think I've heard you use a rule of thumb when it comes to discussing this, but and maybe you can unpack this for us. But and this is on the fact that deposits tend to reprice faster than loans. Can you really explain that in our context of what that exactly means?
The rule of thumb is deposit costs move faster than what you charge for loans. So, for example, let's say interest rates fall by 1%. What you earn on your deposits in your bank falls immediately. They change that right away. But what you pay on your mortgage, it takes a while to reset. So what that meant is historically, over a long, long period of time, when interest rates declined, because deposits went down faster, or the amount the bank pays for to borrow that money from you and lend out, because it falls faster than the amount that gets charged for loans, the banks earned higher net interest margins, which is the spread revenue between what they pay you and what they charge you on your loans, i.e., they become more profitable. And the inverse was largely true, which is as interest rates rise, deposit costs rise faster than, or what the banks have to pay to get these deposits rises faster than what they can charge for loans, and you get margin compression. And so this is where you are today, for example, which is interest rates rising, and you're starting to see it pressure net interest margins. And you're starting to see it weigh on profitability. And that I think is a good rule of thumb to keep in mind. Again, it always depends. It can be very situational, but I think that's a good rule of thumb and one to keep in mind at all times.
And on a related note, the performance of the Canadian and global economy is another key factor you consider. So how might this affect the stability of the Canadian banks?
I think we're very tied to the U.S. economy. So, to go the iteration, I think what's happening to the global economy and how's it influencing the U.S. economy? Because that's by far the biggest variable. And so, what is GDP growth in the United States? If it's very robust, then typically Canada is getting pulled up. If it's doing very badly, Canada is getting dragged down. But now I think what you would say is over the last 15 years, the Canadian banks have made major forays, into buying businesses, financial services businesses in the United States. So now it's not just what does the global economy say and how does that influence the US economy? And then therefore, how does it influence the Canadian economy? It's also the direct influence of the US economy on the Canadian bank's US subsidiaries. So it definitely matters. While it's true these things have an influence, it's also true that some parts of the global economy might be doing well, other parts aren't. And so this is just another layer of diversification on the Canadian bank business model and the influence on their operating results.
A question that I think that's going to be burgeoning for a lot of people, and one of the major weights in our Canadian economy is the housing market. And there's been some concern about the impact that those rising interest rates may have on the rate of mortgage defaults. So in your experience, how significant of a factor is the stability of the housing markets to the Canadian banks?
Yeah, so it definitely matters. This is a bit of an issue that's not maybe as well understood as it could be, certainly in the financial press, if I may. The reality is that residential mortgages, the way they are structured in Canada, they're almost designed to produce almost zero loan losses. So what do I mean by that? So we all know that if we go into a bank and we try to get a mortgage, but it's a higher ratio mortgage, we don't have a large enough down payment, the government requires us to pay premiums to self-insure against our own credit risk through CMHC. CMHC is the government agency that deals with the banks, and it manages mortgage insurance. It manages a mortgage insurance program for Canadian borrowers. So roughly half of Canadian bank mortgages are what are referred to as CMHC insured. They're insured mortgages. So what that means is that if those clients default, it's the CMHC that makes the bank whole because those mortgages are insured. So as it happens, that's, as you might guess, the half of the mortgages that are the most vulnerable. Let's take a hypothetical where home prices fall. Let's just say for the sake of discussion, they fall 30% in 3 months or something like that. So a significant decline. So what does that mean? It probably means that credit losses on residential mortgage loans still remains close to zero for the banks. CMHC, that's a different story. But for the banks, generally speaking, it doesn't produce any meaningful increase in loan losses, therefore something that detracts from Canadian bank profitability. What it does do, though, is it influences the economy. So if home prices fall 30%, it probably means there's a recession. It probably means there's all kinds of other things going on. So it weighs on consumer confidence. So people might not spend as much. The economy might not grow as much. There are other loan categories which are much more directly sensitive to falling home prices. construction loans, right? If you're building condominium complexes, things like that, commercial real estate, which people are talking about right now in the United States. But, we are getting to a point where, as we read, and as the banks have disclosed, an awful lot of mortgages now are starting to become negative amortization. They're starting to start to have more people who are in default, which brings you to, a very, very important variable, which is, what is the unemployment rate? So if the unemployment rate is lower, that usually means that there is not that much, there's not as much a risk of rising loan losses and therefore falling profitability as there might otherwise be. That is actually an extremely important variable. If you start to see unemployment rising significantly, then you can almost certainly expect that the Canadian banks will see lower profitability because credit costs will be rising.
All right. Now we've kind of talked about a lot of those big picture kind of factors so far. So let's drill down onto some of those individual factors on the bank level. So what are some financial metrics and ratios you consider when researching Canadian banks?
Yeah, I mean, there's lots to unpack because they're large and complicated companies. But I think the first one that everybody thinks about is what is the price to earnings multiple? What is the market prepared to pay for $1 of earnings, which takes you to earnings per share? So what is earnings per share growth? Is it higher or lower? Obviously, there's strong correlations among the group, but how much are they earning? How volatile are those earnings? How much at risk are they? I think the second one that's really, really important that we talk about a lot is return on equity. So you have seen the banks that have performed the best, they have much higher returns on equity than the other banks. And because of that, it means that as each reporting period goes by, they generate more money per dollar of capital, and therefore they have more money to invest and generate more earnings. So a bank with a higher ROE, and we have two in Canada, which have very high ROEs relative to the peers, they tend to do better, and that's because they have this sort of structural advantage. In terms of another financial metrics, obviously it's very important what your capital ratios are, because that speaks to how strong you are. Capital, if you speak about it theoretically, is the amount of money you have to absorb unexpected losses. And so it's not just an offensive measure in terms of what can you deploy, what can you invest, and how can you generate earnings. It's also a defensive one, which is how much unexpected losses can you absorb. So you're what they call common equity tier one, but let's just say core capital for the sake of the audience. And then in terms of balance sheet strength, then you would also think about how much money or allowances have you set aside for what they call expected losses. So capital is for unexpected losses, reserves are for expected. And right now, reserve levels are very, very high, in part because of this new accounting that I referred to earlier. So if you think about it, earnings per share in absolute sense, growth, what's your ROE, what's your balance sheet strength, both capital and reserves. And then you're thinking about, okay, all of that wrapped together, what's the market expect for you to do?
Right, exactly. That actually leads to our next questions. There are obviously these influences that affect the financial stability and resiliency of the banks, but when it comes to the performance of these bank stocks, it also comes down to investor expectations that play a major role. So what do you mean by that?
100%. So there's two things going on right now. So the market is forward-looking, obviously. The analysts try to be forward-looking. And then, as I mentioned earlier, this reserve accounting, which is very, very new, and I won't bore everybody with the details, but the banks have set aside these massive allowances, and the changes in these allowances, which account for a lot of earnings volatility, they're very forward-looking. So you have the market forward-looking, you have the analyst forward-looking, and then you have the accounting that's very forward-looking. So by way of reference, let's call it normal times, not amazing times, but normal times. They probably trade at 10.5 times, something like that. In really good times, when GDP growth was 3.5 and everything is fine, and the world is filled with sunshine and rainbows, they might trade at 11. So right now, if you're at less than 9 times, and you might ordinarily trade at 10.5, you're probably trading at a 20% discount to where you would ordinarily trade. So why would you be trading at that kind of discount? Fundamentally, you have the analysts, or what they call the sell side, think the banks can make X. And then you have the market, by virtue of, you can infer from these valuations, thinking they can only make like 80% of X. And so, you have this bit of a disconnect, if you will. But what's really interesting is that the operating results are actually not that bad. They in the most recent quarter, they earnings were not at all-time highs, but not that far off. They had ROEs of 14%. They still have very high capital. They have very high reserves, as I mentioned. And loan losses, the ratio of loan losses are still less than half of the long-term average. That's actually fairly amazing. If you read the average financial press and commentary on the Canadian banks, you would think that credit was out of control or at least getting out of control. One of the interesting things is they're actually reporting loan losses that are less than half of normal. History has been very kind to long-term investors who bought the Canadian banks at less than 9-term earnings. So if you're a long-term investor, history has suggested that buying at these valuations, if you are a long-term investor, can be a very, very good entry point. That would be history.
There you go. That certainly perked my ears, and that's an interesting stat that and knowing that the loan loss provisions are quite less than what historically they are. So,
Oh yeah,
thank you for pointing that out. Now let's take a moment to hop into WebBroker to find out how to find and compare some of those metrics that Rob just chatted about across the different industries and comparing it against its peer groups.
Now, since we're talking about Canadian banks, we have Toronto Dominion that we're going to be using as our example here. So once you've got the profile of the particular bank you might be looking to analyze, we are going to head over to the fundamentals tab, and that's where we're going to find some of this information here. So once you're on the fundamentals tab, we're in fact first landed on the industry comparison page. Now we wanted to first start off by drawing your attention to this first number up here, which stands for earnings, and the TTM stands for trailing 12 months. So this essentially tells us the previous 4 quarters essentially from current what the earnings per share value is. Now, why is this important for us since we're talking about price to earnings? This is the number that's used to come up, if we scroll further down here, with the price to earnings ratio. In other words, the PE ratio. And the way this number is calculated is it takes the current stock price, so let's just round it up and call it 79 at this point, divides it by the earnings per share, and that's how you get this ratio. And if we go further down one more step over here, we're going to see the return on equity number as well. This is expressed as a percentage, and this really talks about how effective is management in using the capital and returning profit with the capital that they have. And so this is a number we can also look at. Now, beside it, we also have the industry average, which really allows us to benchmark it and say, where does our particular bank stack up against the industry average as well? Now, from here, we've done a comparison just looking at it on an isolated situation with the bank alone. But if we wanted to compare against some of its peers or competitors, then we can go to the next tab over here at the top, peer comparison, and we can look across some of the major big financial institutions and look at those numbers again with those same metrics, the earnings per share, and then we can also compare it with the PE ratios that they have across the board, as well as the return on equity. If I scroll further down here, we got the return of equity numbers over here. Now, this allows an investor to really compare against its peers and try and, again, have context to where these numbers are standing high or low against each other. But what if we wanted to compare against historical numbers and see how those numbers play out? So to do that, we're in fact going to head over to our reports section over here. And once you come to the reports, this is where we have these analyst reports similar to what Rob would have done in his time and crunching those numbers for us. I'm going to pull up Thomson Reuters stock reports. I already have it up on screen. So I'm just going to flip over to that, and we've scrolled to a section which is about relative valuation, which allows us to look at it from a historical context. So again, we have the comparisons against the banks, and we can see what we wanted to point everyone's attention to was these numbers: trailing PE, so that's trailing or historical price to earnings ratio, and then the forward expected price to earnings ratio. And we can see in both instances, they're sitting at about 9.9 on the historical, and the forward looking is at 9.3. However, if we look at the 5-year average, what's happened in the past, they've typically been sitting kind of higher at that 11 and a half range. And so this, based on this report and what they have looking at the 5-year numbers, this may be an indication that the stock is currently trading at a discount or would be considered to be undervalued. On the next page down, we can see this in a graphical depiction. We can measure it across time, and this again across the 5-year period. And we can see this perforated line over here represents that average. And again, we mentioned it may be perhaps trading at a discount because it's below that average. And similarly, if it was ever above that average, it would be considered to be trading at a premium or where it would be overvalued. And there you have it. So that's a little bit of the metrics to look at to help you with your analysis when looking at Canadian bank stocks there.
All right, we're going to leave our conversation there for the time being, Rob. Thank you so much once again for unpacking a lot of those factors for us. Any final thoughts you'd like to share with our viewers about evaluating the resiliency of Canadian banks?
You know, as I mentioned earlier, the banks are trading at very low valuations, less than 9 times forward earnings. And you don't get these valuations when there's sunshine and rainbows. You get these valuations when there are storm clouds. And not to, give an overly simplistic metaphor, but really the question that people are kind of trying to figure out right now is, are the storm clouds or the prospective storm, is it going to be enough to influence the foundation of the Canadian banks, namely profitability and capital? And I think right now, based on all the things we've talked about, the sector is very, very well positioned to deal with any storms and storm clouds. So when you think about the valuations, they are assuming an awful lot of bad news. The question is, how bearish are you, and how pessimistic are you, or how optimistic are you? And that very much weighs into what your view is on the sector. So that would be my final thought.
All right. Well, thank you again for that, Rob. Really appreciate it. So, and thanks for joining us again. And for those of us in our audience, please make sure to register for upcoming live webinars and check out our library of on-demand content available on our Learning Center and on our YouTube page. Until then, we'll see you all next time.